presentation contains current opinions of Moe Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Moe's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone, and welcome to the YouTube update for Compak Asset Management for October the 24th, 2023. I'm Mo Ansari, President of Compak Asset Management and host of Market Wrap. Don't forget, we are going to go digital on Market Wrap. On all the radio stations that you used to listen to Market Wrap, it's not going to be there. It's all digital. We're changing with the times. So make sure you go to compak.com/media and download the app. That's all you need. There's a link there that you can download the app, so on your iPhone you'll get Market Wrap. The Market Wrap will be there. It'll automatically be downloaded and you can listen to it, besides getting the updates from YouTube and all the other things that we do. I'm going to talk about the Fed a little bit, what they're doing, the market, the economy, technical analysis, and the week ahead. So let's start. I'm doing this in the afternoon, right after the market closed. So let's start with the Fed. The balance sheet for the Fed is starting to come down. That is, they're selling about $95 billion a month. That is, that matures, the bonds that mature, they're not replacing those bonds. So what they're doing is, as they're letting them roll off, so the balance sheet, which is getting close to $9 trillion, is going to come down by nearly $1 trillion a year. That is a tremendous amount of money that the Fed is bringing down. Now, the Fed has not raised interest rates. The probability is they're not going to do it on November 1st, 99% probability. And the probability that they're not going to raise interest rates in December is down from about 39% down to about 25%. So as I said in July, I think the Fed is done raising interest rates. We don't have the confirmation yet. Now, there's a lot of uncertainty in the market right now. As I mentioned 2 weeks ago, as long as we don't see an expansion of the war in the Middle East, financially, unfortunately, it's a tremendous human tragedy, but it's financially, it does not affect the markets as long as the war does not expand. If it does, then we can see some problems with oil supplies, oil prices shoot up, and that becomes a much bigger problem for the markets to deal with. But if it's Gaza and Israel, then it does not affect us financially at this point. Looking at the market, the long-term treasury yields are driven by economic growth and inflation. If inflation is running at about a long-term year, about 3%, and we get 2% growth, we should see interest rates year-over-year growth at about 2%. Then the interest rate should be around 5%, and that's where we are. We're going to get GDP numbers later on this week. We did get Microsoft today after the market closed, better than expected. Microsoft is up about 5%. We got Alphabet, the parent company of Google. That came out not as good because their cloud services are not growing as much, even though their revenue was a beat, but they're down about 4 or 5%. Earnings overall are coming in better than expected, but they have been sort of relegated to the background with interest rates going up to 5% on the 10-year. I projected that last year. The projection, I'll show that to you, that we projected from last October's high in interest rates at 4.33. The projection was 4.93 to 5.03 for the 10-year. I said, well, that would be dramatic if it does happen. Well, it did. We hit 5% this week. We backed off from there, which just gives some market some breathing room. I think we are done with raising interest rates or the interest rates going up. The market has already raised rates by about 80 basis points. That's the equivalent of the Fed raising interest rates 3 more times. Market has already done that. I think the market has done the Fed's job, and the Fed is not going to raise interest rates anymore. We are going to see some slowing in the economy. We haven't seen that yet, especially with unemployment. As long as unemployment remains low, we don't get a recession. That's what I've said for the last 2 years. Looking at the financial conditions, they have tightened up dramatically, as I mentioned. And that is worth 80 basis points of interest rate increases that we have already seen in the market. So if the Fed, whatever the Fed does, really becomes irrelevant because we've already seen a tightening in the market with interest rates on the 10-year hitting 5%. I'm going to a live webinar next month. It's going to be the last one of the year. If you want to come and attend, it'll be about an hour and a half, and I'll try to answer as many questions as I can. So jot that down. You can go to compak.com/seminars right here at the bottom of your screen. You can go there and register. It's all free, and I'll do that. Let's take a look at the technicals. Market came. This is a daily chart of the S&P 500. 4237 is the 200-day. We went below it. We are back above it. We closed today at 4250, or that's where we were when I updated this chart going into the close. Again, this is more like a Pinocchio. A Pinocchio is where the market goes below a technical support level or breaks above a technical support level, but it's not real. It's a lie. And that's what I call it, a Pinocchio move. We saw that in March of this year when the markets came down, went below the 200-day for a few days right here, and then just took off from there. Everybody got stopped out of the markets. I still feel that this is the fifth wave bottom, even though it's showing wave 3 here. I still think this is 3, this is 5 right here. It's a new low that we've made, and we will see if we can get above the 20-day and the 50-day. We came here, tested the 200-day, got up to the 50-day, failed there. Now we're back down again. I'd like to see us get above 4,400, where this gap gets filled on the charts. That would be significant, and it would signify to me that a bottom is in. Somewhere around the middle of October is where we make a bottom. Well, we're a little bit, just maybe a few days late there. Weekly charts, the major number that I'm looking at is 4180. We got very close to that yesterday. We bounced off of it today. So 4180, if we break that, that's a long-term trend line chart that I have. That to me will turn everything negative if you break below 4180. That's where I would get very concerned and think we could go down. Then all the way next support is around 3,800, significantly lower. But I think we are in the process of beating a bottom as long as we don't see an expansion of the war in the Middle East. And that's geopolitical risk, which nobody can really calculate. And then we have the interest rate risk. We have to have the Fed coming in and start showing that they're going to back off and not raise interest rates. I showed you the chart on the average return in the S&P after the Fed stops raising interest rates. Last year I showed you the chart where when the inflation peaks out, what happens 12 months later for the market. I showed the same thing to you at the last webinar, what happens for the Fed stops raising interest rates. We're not there yet, but they might have already done it in July. 12 months after that, what does the S&P do? The last 6 events that we've seen when the Fed stopped raising rates, the cycle turned, the S&P did very well on average. So I'll show you that chart. Come to the webinars and you can see those there. NASDAQ down again, closer to the 12,700. We got 13,000. We got a little bit below that yesterday. I think this is about it. Fifth wave bottom right here. And then we start turning back up on the daily charts. Weeklies, as long as we stay above 12.3, I think this is all fourth wave pullback. Wave 1, 2, 3, 4, and then we're going to start the fifth wave to the upside, which should take us somewhere to about 15,000 for the NASDAQ over the next year and a half or so. But in the short term, it has sort of taken out everybody. This correction, August and September, usually does that, takes out all the nervous nillies out of the market. They go running. All the people who always buy the highs, sell the lows, snatch the feet from the jaws of victory, they're done. At this point, just about everybody is very gloomy. Market is oversold. We've got technical divergences. I like all of that. I think we're very close to a bottom as long as the war does not expand in the Middle East. That's a big caveat. This is the chart that we talked about. This is 4.93 to 5.03. This was a projection from last October's Fibonacci projection from last October's low high in the rates. We got really close. We got to 5%, and now we're starting to back off. I don't want to see it getting much above 5.3%. If it does, then we've got a problem in the markets, and probably we've seen expansion. Some fundamental thing has changed. Though we could see expansion of the war in the Middle East, or the rates are going up, inflation is going up, oil prices are going up, and all of that would be negative for the economy and the stock market. But that's all the negatives that can be out there. Gold make a fifth wave low right here, and that's usually the end of the move. Now we've started to move, broke above the 200-day moving average. We're coming back down a little bit. Any pullback to the 1942 area, the 1980, which is right about here, the resistance right here. And if we can get above 2,000, probably 2085 or new highs in the gold market. Looking at the crude oil chart, made a high, came back down, bounced up, bouncing around. It's all depend. There are very few technicals you can look at crude oil. It's all based on what happens geopolitically in supply and demand. Those are my thoughts. Those are my views. We did get earnings today from Microsoft, as I mentioned. We get Amazon later on this week. We get some other major tech companies this week. By next week, we'll be done by the biggest, largest companies in the S&P 500. We'll have a few laggards, but that'll give us an idea of what the earnings look like, which are coming in pretty good. Again, if you need help with your portfolio, give us a call, make an appointment, stop by the offices, or set up a Zoom meeting. Go to compak.com. Those are my thoughts. Those are my views. Don't forget to download the app from compak.com/media so you can get Market Wrap directly from your phone. I will be back next week. Until then, good trading.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that over-focus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.